Hello everyone, now that we've analyzed all the information from Marlin Guitars, we're ready to build the company's income statement. Again, to make our information more useful to users of our financial information, we're going to break it down into sections. And the first section is going to be the sales section. And every income statement always starts with the same thing. It starts with the revenues that your company made during the period. So what we can do here is we can go into our information and find out how much sales revenue Marlin Guitar had during the period. And we see in our information they made $8 million in gross sales, but we want the company's net sales, so we need to reduce that gross amount of gross sales by anything that's applicable. What would be? Well, discounts. Maybe we gave customers a discount for prompt payment or for ordering in large quantity. Returns and allowances. Yes, we made the sale at some point, but then whoever bought the goods from us, they sent them back. So these two things are what they call contra revenue accounts. And we have to subtract our contra revenue accounts from our gross revenues to get to our net revenues. So we're going to go to our information, find out what Marlin's sales discounts were during the period, and we see here that their sales discounts were $50,000. Bring that number over. And we're also going to find the company's sales returns and allowances in our information. Again, that was $100,000. So in total, Marlin Guitars had $150,000 worth of contra revenue accounts, which means their net sales, yes, they did $8 million in sales, but $150,000 of it never really actually existed. So if we subtract $150,000 from the $8 million, we see they did $7,850,000 worth of net sales. Well, the next thing users of our information are going to want to know is what was our gross profit. And to find our gross profit, we need to subtract our cost of goods sold from those net sales. So let's go over to our statement over here and find our cost of goods sold. And as we see here, the cost of goods sold for Marlin was $4,350,000. We bring that on over, and then we take our net sales minus our COGS and determine that Marlin Guitars had a gross profit of $3.5 million. So that's how much they made just from markup on goods. But they had other expenses to pay, typical of operations, separated into three different classes. What is applicable to selling? What portion of those expenses went to paying our administration, and what portion of our operating expenses were caused by research and development expenditures? When we report these things, it lets users our information know things like, are they spending a lot on selling expense? Are their administrators overpaid? Are they investing into the development of new products that will help them stay in front of their competitors? So let's start with the first section, which is our selling expenses, and this is going to go into the leftmost column. First thing that we have is our sales, salaries, and commissions. So we're going to find that information, and we're going to see that they had $400,000 worth of sales, salaries, and commissions. Next expense they had was supply, stationery, and postage related to selling. So we're going to find that number. That was $20,000 given in the information. We had depreciation on our company's sales equipment. Well, that was $80,000. So we're going to bring that number over. And then lastly, our other selling expenses, or anything else that's various, was $300,000. We're going to bring that number over. And then when we total it up, our total selling expenses are going to be equal to the sum of those four numbers. So equals sum with that range of cells in parentheses, $800,000. Let's do the same thing for administrative costs, our officer salaries. We go to our info and we see that our officers made $520,000 during the year. We have supply, stationery, and postage. This time for administration was also $20,000. We have depreciation of our office equipment. Find that in our information, and it was $20,000 as well. And then we have our other admin expenses from our information, which was $80,000. Again, if we find the sum of those four numbers, we find out what our total admin expenses were. And when we do so, our total admin expenses were $640,000. And the third component of operating expenses is our R&D costs, our research and development expenses. Given in the info, they spent $100,000 on research and development of new guitars during the period, which means we can just bring that number over to the middle column. If we had multiple components of R&D expenses, we would total it up in the left-hand column like we did for selling expenses and administrative expenses, but since we just have that one number, we can report it right in the middle column. And when we add those three numbers together, our three components of operating expenses, which are our $800,000 in selling expenses, our $640,000 in admin expenses, and our $100,000 in research and development expenses, we find out that Marlin Guitars had total operating expenses during the period of $1,540,000. So now we need to find our income from operations, and to do that, you take gross profit and you subtract out your total operating expenses. Marlin Guitars, after they account for their operating expenses, had $1,960,000 worth of income, which was generated from their typical course of operations. But it's not the only way they brought money in. Right? Marlin Guitars is renting out a building adjacent to their factory to another company. Well, they're not landlords, so that's not part of their typical operations. So when we report that rent revenue, we can't report it as an operating revenue. We have to report it as an other revenue. So let's go and grab that rent revenue from our information, and it was $72,000. Again, if you had multiple others, you would total them up in the middle column and then move the number over to the right, but since we had just one number, we're going to start it right on the right side. If we take our income from operations, add to it our total other revenues and gains, we get this no-name subtotal of $2,032,000. Well, we added our other revenues and gains. Let's subtract out our other expenses and losses. Interest always goes as an other expense. It's just the way that GAAP mandates that companies have to report it on their income statement. So let's go find their interest expense on their notes payable. And that was $32,000, which means our income from continuing operations before we account for income tax is going to be equal to this no-name subtotal minus our interest on notes payable. Or if you wanted to do this another way, instead of having this be equal to the cell with the interest on notes payable, make it interest equal to the negative of that cell, and it reverses it. So now we got to change our formula to add them together. You're free to report it either way as long as you come to the correct number. What I'm saying is don't inadvertently add your interest expense. I prefer this method because I just like to have negative in brackets. So with that being said, now we got to account for the income tax that Marlin Guitars had to pay. Well, if we go to our info, there's no income tax listed. So what are we going to do? Well, good thing is if we go up, we see on this line right here, Marlin is taxed at a 30% tax rate, which means the company is going to have to pay 30% of that income from continuing operations before income tax. So if we just take that number and we multiply it by 0.30, we determine that Marlin is going to have to pay $600,000 in income tax, which means after they pay that $600,000 in income tax, they will have $1.4 million left of income from their continuing operations. That line lets users our information know, okay, that's what we can expect to see next year. Like all of the things that they did last year that they're going to continue to do next year led to $1.4 million in income. But that's not all that Marlin had. They discontinued an operation. They got rid of that acoustic division, which means we also need to disclose how much income can be attributed, or maybe a loss can be attributed to this discontinued operation of the acoustic division. So if we go and start with our income from operations of the acoustic division, we see, given in our information way at the bottom, $800,000 worth of income from the acoustic division. Well, that's pre-tax income. We want to subtract out our tax. So how are we going to do that? The same way that we did before. We're going to go and we're going to multiply that by our tax rate, which is 0.30, and say, yes, we had $800,000 worth of income from operations of this division, but we had to pay $240,000 in taxes, which means our after-tax income was only $560,000. Next up, we have a loss on the disposal of acoustic division. So we had machines. We had stuff that was only there to make acoustic guitars. Well, We're not making those guitars anymore. We don't need them. So what are we going to do? We're going to sell them. And if we're selling them at a price that's less than what our books say they're worth, our company's going to experience a loss, which is happening to Marlin Guitars right here. If we go into our info, we see that their loss on the disposal of the acoustic division was $1 million. So what we're going to do is I'm going to hit equals negative and go over to the info and find that $1 million and bring it over. We lost money, which is a bad thing. The only good thing about losing money is it offsets your taxes. It means since you're not reporting as high of an income, you're going to have less taxes. So they didn't really have $1 million loss because some of that loss helped them save on taxes as well. So what we're going to do is take that number and we're going to go and we're going to multiply it by 0.30. We're going to come up with 300,000, and that I don't like is negative, so let's make it equal to negative cell B35. We had $300,000 savings on our income tax, which means that in total, the loss of income that our company had when we account for that tax offset was $700,000, which means the acoustic division in total brought in $560,000 in after-tax income, but we also experienced a $700,000 after-tax loss on its disposal. Getting rid of this acoustic division cost us $140,000 during the year. And by reporting it like this, it tells our investors we're not going to lose that $140,000 next year because we're rid of this division. So, what is our net income? Our net income is equal to our income from continuing operations plus, in this case, the amount that we lost on discontinued operations, $1,260,000. So that is the net income of our company. But we got a catch in here. Not all of that income is entitled to our shareholders. Why? Because in our information, we've got a non-controlling or minority interest. Where is that? It's right up here. It says Marlin owns a controlling interest which is greater than 50% in another instrument retailer. And since we own more than half, we have to consolidate our numbers. We have to include all of Gibbons Guitars numbers into Marlin's Guitars numbers. And then at the end, what we're going to do is subtract out any portion of Gibbons Guitars numbers that Marlin's owners aren't entitled to. What do I mean by that? Well, bottom line, during 2017, Gibbons had income from continuing operations of $200,000. And we reported that whole $200,000 into our net income. But all $200,000 doesn't get to go to our shareholders because we only own 80% of the company, which means the other 20% of that $200,000 is income, which is attributable or can be allocated to these non-controlling interests. So what we got to do over here on our income statement is figure out that, okay, we got 80% of that 200,000, which means 20% is going to these other interests. So if we take the $200,000 in income that Gibbons Guitars had, multiply it by 0.20, the portion of the company that we do not own, we come up with $40,000. So our net income was $1,260,000, but $40,000 of that can't be allocated to our shareholders because it's going to these other interests, which means there's only $1,220,000 which can be allocated to our own shareholders. And that net income allocated to your company shareholders is the actual bottom line of the income statement. But GAAP is going to require us to do one more thing, because companies come in various sizes. $1,220,000 might be good for us, where it would be terrible for a really huge company. So to make it easier for potential investors to compare the income of two companies, we have to break it down on a per share basis. So the first thing we have is income from continuing operations. And for this, what we're going to do is we are going to take our income from continuing operations, but then we got to subtract out the portion of it which is allocated to this minority interest. And after we've done that, that's the amount of income from continuing operations that we can have for our shareholders. And we got there. But it's not on a per share basis. To make it a per share basis, what we need to do is go into our info and find out how many shareholders we have. How many shares do we have to spread this amongst? So we're going to go through our information, and we're going to find right here, Marlin has 500,000 shares of common stock outstanding. So if we go back to the income statement, and we get rid of this because we don't want that, we divide it by the 500,000 shares that we had outstanding. Comes out to $2.72. So for each share that we have outstanding of Marlin Guitars, that share is, I don't want to say has the right to, but you know, that share has access to $2.72 of our income. Well, let's do the same thing from our continuing operations and their discontinued operations. How am I going to do this? It's pretty easy. What I'm going to do is I'm going to go and find the after-tax amount of income we had from continuing operations, and I'm going to divide that by the same 500,000 shares that we have outstanding. If there's $560,000 worth of income from this discontinued operation, and we have 500,000 shares, that means each share is entitled to $1.12 of that income from the discontinued operation. And then lastly, let's account for the loss. And our loss after tax was $700,000. Well, let's go. Let's divide that by 500,000. And we're going to come up with $1.40 worth of loss that each share experienced when we got rid of this acoustic division. And if we add this all up, we're going to come up with a total EPS, earnings per share, of $2.44 per share. How do I know if that's right? Well, we can do it this way, and I'm just going to do it off to the side right here. Our total net income that we're reporting is this $1,220,000, right? And we know that we have 500,000 shares outstanding. Well, if we divide that out, how much net income can be allocated, if we want to each single share? And that is, if I move the space over, $2.44. That's your check. When your total down here on the bottom line is equal to the amount that you have by taking your net income and dividing by the number of shares outstanding, they should always be the same number.